welcome to this virtual press conference as BK Group PLC presents its reviewed financial results for the financial year 2021. My name is Audrey, and I will be moderating this session. I would like to thank you all media partners for honoring our invitation and joining us for this virtual event. In 2021, BK Group recorded a strong financial performance. And on this call, we have BK Group CEO, Dr. Diane Karusisi, and CFO Nathalie Mhaka, who will take us through 2021 financial results. After the presentation, we'll also have a Q&A session. Please feel free to also drop your questions in the chat box. Without further ado, allow me to welcome BK Group CEO, Dr. Diane Karusisi, for her opening remarks.
Thank you, Audrey. Good morning, everyone. Thank you for joining our call. Today, we are delighted to present BK Group financials for 2021. You will see that the group has recorded a very strong performance with a net income growing by 35% year on year. And we've seen very strong performance across all our business lines: banking, insurance, investment banking, but also technology. You'll notice, as you look at our numbers, you'll notice a very strong performance for the bank, in particular, which is the largest subsidiary, with clients' balance and deposits growing by 23%. This is a record in the past couple of years. We've been trying for a long time to grow our deposits faster than we grow our loan book, and this has been achieved this past year. You'll also notice a very strong performance of our non-funded income, growing by 41%. This is also a trend that we've been working on for a couple of years, and we are very delighted to see that all our efforts are now paying. I think our shareholders will see, as recommended by the Board of Directors, a dividend of 28.7 francs per share, which it gives a dividend yield of 11.5%. We believe this is a very good performance for our shareholders. So as I said, across all our business lines, very good, strong performance. And this is a reflection of economic recovery. And we've seen numbers published by the National Institute of Statistics with a GDP growth of 10.9% in the past year. And we believe that Rwanda is back on the path to growth and transformation with a double-digit GDP growth, which again is expected for this year, 2022. For more details, I'll let my colleague Nathalie take you through the details of our financial performance for 2021. Thank you.
Thank you, Diane. Good morning, everyone, and thank you for joining us today for the publication of our FY21 result. As mentioned, we are very pleased with the strong growth. We started the year thinking the recovery will take some time post-COVID-19 pandemic. We are pleased to see that at macro levels, things have picked up faster. This has translated for us, this has enabled us to deliver the result that you are seeing as published today. So for the full year, our total operating income grew by 25%. And that is mostly a good mix of growth, both on the performance from the loan book side, good balance in terms of customer deposit costs, and also our non-funded income. We saw the business go aggressively across all business lines. Our SMEs, from the banking perspective, you have our SME business growth. Various new products were offered to the market, and that has helped us achieve this high result. Our general insurance subsidiary also grew significantly, and that all combined into this non-funded income ratio that we've been able to deliver. In the year, when you look at us compared to the market over the past 5 years, you'll see that BK Group has maintained a strong growth stance. So we have performance on total assets at 20% compounded annual growth rate. That on page 2 of the press release, against the market at 16.3%. When you look at the competition that has tightened, we have a couple of new capital injections in the market and new business coming into our market, we've managed to outperform and maintain our leading position. When you look at our market share, we are still growing all key metrics. Our total asset market share increased to 31.4 from 30% in 2020. You have our net loans growing to 36.5. That despite a very challenging market condition led, due to COVID-19 pandemic. Customer deposit growth, very, very impressive, as mentioned by Dr. Diane. For 3 consecutive years now, we are seeing growth on the customer deposit quite strong. We are very pleased, to continue with this trend, and this is now outperforming our loan book growth. So customer deposit market share is currently at 31.6% from 29.9% in the previous 2 years. Shareholders' equity, we are maintaining close to 34% market share. When you compare year on year, we've grown 10% compared to 18.9% of the market. This is after taking the provision for dividend payable at 50% payout ratio as approved in last AGM. So all in all, very strong growth. Our total asset is now 1.6 trillion Rwandan francs. When you compare this in dollar terms, you are looking at total asset of 1.6 billion, and you have the Kenya shilling equivalent of 178 billion Kenya shilling of total asset, of which 109 billion Kenya shillings are customer deposit. Very strong liquidity that we are holding, being deployed mostly in the loans, 120, I'm speaking in Kenya shilling terms for our market on the Kenyan side. We have 120 billion Kenya shillings worth of gross loans, and the rest being invested in securities, government securities and the like. On the key ratios, we see some strong performance as well. Our return on average asset and equity improved to 3.6 and 19.1 respectively, from 3.3% and 16% in FY20. You are looking at most of this growth on the income statement being also supported by good cost efficiency. So we are seeing, although we've resumed most of the activities on site, like project consultancy cost increased. We also had IT expenditure due to connectivity cost increase. We have resumed our recruitment activity, so we saw some increase on personnel costs. We, however, were very pleased to see that we managed to reduce our cost of risk. Cost of risk that is still elevated when you compare us to the region and other competitors. We are still at 3.5. Our ideal target is at around 2%, 2.5%. We managed to reduce this from last year, 4% range to 3.5%. And this has translated into a reduction of net impairment on loans and advances of 8.2% year on year. So we expect this to continue in the year as we are still holding a high NPL ratio. Our NPL ratio is still elevated when you look at the market at below 5%. Our target is to bring this down below 5% in the current year. Overall, as our tax expense was normal, we have an effective tax rate of around 31%, generally linked to the add-backs for disallowable loan loss provision costs. And to that, I want to highlight that when you look at our provisioning, we remain very prudent. Although our NPL and asset quality is improving, our NPL coverage remain elevated and increasing. We are currently at 124%, compared to 107% during the pandemic, and so 105, 106% range previously. We remain prudent because we want to look at the full impact of the pandemic post 2022 before we release some of this provision we are holding for our large exposure. Overall, our As I said, asset quality is slightly higher than the market, 4.6 for the market and 5.3 for BK Group. For return on equity, we remain higher than the market at 19.1 compared to 15. Cost to income ratio very efficient at 36.3% when you compare to our previous averages before COVID at around 40. And the market is still, the competitors are still at around 50%. So we are quite pleased with this result overall. As I said, all subsidiaries doing very well. Our retail customer have reached close to over 420,000 retail customer, and we have over 36,000 corporate clients. On the general insurance side, the business registered a growth of total asset at 40% year on year, and ROE currently at 32% for the general insurance compared to 15%. Compared with 15% on the asset side. The market is still returning some underwriting losses. We are very pleased that our general insurance that was greenfield a couple years back has managed to release a 32% ROE in such a short time. We are very confident that the market still has a lot of potential and that we will see this even grow better in the current year. The other subsidiary also doing quite well. BK Tech House sales revenue increased to 1.2 billion compared to 954 million in the previous year, and net operating income increased by 117%. The profit for BK Tech House, which is still in the early days, was 308 million Rwandan francs, very strong growth, and they're still registering growth for digital consumers on all the free platforms. The smart Unganire system, we have the Urubuto education system, and the university uptake is quite positive. On BK Capital, the asset under management grew by 94% to 21.4 billion, mostly driven by the uptake on and the subscription for Aguka Unit Trust. Very popular. The return is above 10% for the market, and that's quite well perceived, mostly for the retail investors. Overall, the profit was 152 million in FY21, a growth of 32% year on year, and 29% for operating income. On the ratios, we saw no big, no significant shift. We are still well capitalized at 21% capital adequacy ratio. And when you look at large exposures to core capital, very within previous expectation at around 230%. Our FX deposit to total deposit, so FX exposure also improving. We are looking at FX loans to gross loan of 12% from 16-18% in the previous years. You have our FX deposits also reducing to 27% from 31% in 2020. Our network remain quite stable. We still have the same branch network. Our focus currently is to serve our customer digitally through different payment system, agency banking network, and uptake on our digital channels. I'll pause here for questions. Thank you.
Thank you very much. If you have a question, you can raise your hand, but you can also drop the question in the chat and we'll read it. Thank you. You're welcome for the questions. Question from Charles Okwemba. He's asking, your cost-to-income ratio increased from 32.5% to 36.3%. What was behind the acceleration in costs, and how do you intend to mitigate that going forward?
Thank you, Charles. Indeed, the cost-to-income ratio has slightly increased, but our target has always been to be below 40%, which we believe is a very attractive cost-to-income ratio. So in the past year, 2021, we ramped up recruitment that we had frozen in 2020. And I think personnel costs, I think, is the main line that has increased our costs. We also have a line for bonus that we didn't have last year, and this is the reason for this slight increase in cost to income. But as I said, it remains very attractive compared to what we see in the market, where the cost to income ratio is, averagely above 50%. So we are still very happy, and our target has always been to be below 40%. Thank you.
More questions are welcome. There's a question in the chat. Your loans loss provisions have dropped significantly. Can you confidently say that the worst of the COVID-19 pandemic is now behind us?
Thank you. That's a good question. We've seen banks in the region aggressively releasing provisions. As you'll see, our cost of risk has reached 3.4%, and our NPL ratio is at 5.3%. We've indeed released some provisions, but not all of the provisions that we have. In particular, we've remained quite prudent on our exposure to the hotel industry. We have a couple of hotels that we have not released. We have not released provisions for these hotels. We hope for recovery this year with the many events, including CHOGM, that are organized later this year. So we'll see what happens. But as you see in our results, most of the banks in the region have posted a cost of risk of around 1%, sometimes below 1%. Ours is at 3.4%, which we believe is quite conservative. And there's still room for us to release provisions during the course of this year and next year if the hotel industry shows strong recovery. You'll also see that our NPL coverage ratio is at 124%, which is very high. So we believe we've been prudent in our financials for 2021. The full effect of COVID-19, we don't think is yet to be seen, and that's why we've remained prudent. Maybe Nathalie wants to add something.
Thank you, Diane. It's true we are still very prudent. We're still holding excess provision. However, it's well within the concentration risk that we have in our portfolio. So you look at our top large corporate clients are quite significant in our book. So we want to look at the performance of these big facilities before we can be fully comfortable that our cost of risk can be aligned with other who are big players in SME and retail segment. So 3.4% cost of risk remain very elevated. It's really eating into our profitability. When you look at our loan yield did not improve. We're still at 15.7 flat on FY20. And cost of funds actually remaining also elevated. So this cost of risk also remaining elevated means we are eating into our profitability. We hope that within the next couple of years, you would see us resume our 2% range cost of risk. However, generally, this is a good position to be in, looking at uncertainties that could still hit us, and that really linked to our concentration risk on the loan book. By concentration risk, I mean the large corporate facilities still represent about 80% of our portfolio. Thank you.
There is another question from Juma. BK Group outperformed the banking sector in terms of key growth metrics and like total assets, net loans, client deposits, and shareholders' equity. What's the secret to that performance?
Thank you for the question. Indeed, the group has managed to remain, to maintain the leadership position in the past couple of years. I think that the secret to that is a very disciplined management. We really believe and have passion in what we do. Also, We believe that we have a better understanding of the context. Most of our competitors are regional banks. They don't have the same understanding of the context, the same networks that we have, and I think that's what has been our secret in the past years. We want to continue with a very disciplined execution of our strategy, growing our business in all business lines, be it insurance, banking, technology, and investment banking. We believe economic recovery is going to permit us to do just that, to continue growing our business. And the digital transformation that we've been going through will allow us to be more efficient, and this will translate in better performance this year and in the next years. Thank you.
We have a question from Simon Kamuzinzi from Kigali Today. He's asking if you can give a small summary in Kinyarwanda.
Murakoze cyane. Uyu munsi turagaragariza abanyamakuru ariko n'abantu bose bakurikira akazi dukora muri Banki ya Kigali. Turagaragaza ko twungutse neza umwaka ushize, inyungu yacu yiyongeyeho ku kigero cya 35%. So ni ukuvuga ko banki yakoze neza, n'abashoramari bacu bungutse neza. Ikindi tugaragariza abantu bose nuko imirimo yacu yose dukora, yaba muri bank no mu bwishingizi no mu ikoranabuhanga, hose izo business zose zagaragaje ko zakoze neza, zose zitanga inyungu igaragara kuri Banki ya Kigali. Twishimiye ko abashoramari, abanyamigabane ba Banki ya Kigali bazabona dividend ingana n'amafaranga 28 ku mugabane wo, ku muntu wese ufite umugabane umwe azabona ayo mafaranga 28. Twibaza ko ari performance nziza cyane, kandi bijeje ko n'uyu mwaka tuzakomeza gukora neza kuko tubona ko economy yongeye kuzamuka. Twizeye ko twese tuzakorana neza kugira ngo inyungu ikomeze igaragare kandi abashoramari bayishimire. Murakoze.
Juma has another question. Do you have any plans for Kenya? I know you are not planning to set up a physical branch as you indicated last year, but do you have any such plans even as by the way?
Thank you, Juma. We don't have precise plans for Kenya in the short term, but we continue to observe what's happening in the Kenyan market. It's a very exciting market. We see the Kenyan market is quite, not overbanked, but you have many banks with very healthy competition. But if at all we intend to go to the Kenyan market, maybe it will be in another business line, but this is not on the table right now. But yeah, we are listed on the Kenyan market on the Nairobi Stock Exchange, and we want to make sure investors on the NSE can also get growth and can have exposure to Rwanda through investing into the BK stock. Thank you.
Another question from Jackton Lawi. Are you back to operating at full capacity as a bank to the pre-COVID levels or even more?
So as a bank, we never stopped to operate. We are an essential service, so we, even at the height of COVID, we kept operating and serving our clients without fail. I think this is something we are quite proud of, that we've been able to transition to a remote working environment without affecting our business and our customers. So today, I think most of us have now a sort of hybrid work methods. Most of the people are now working from the office, but every now and then we have teams that prefer to work from home 1 or 2 days a week. But there's no restriction now in terms of movement of people. There's no curfew, so people, are free to work either from the office or from home. But what we've observed is that most people prefer to work from home, and we believe also the social interactions here at the office help teams, advance more and make more progress in what they do. Thank you.
From Sol Utera, what is the outlook for Rwanda's banking sector as the economy recovers from the pandemic and the uncertainties of the Russia-Ukraine conflict?
So yeah, we believe the banking sector will remain competitive. Digital transformation and the migration of all services to digital will remain a trend that we'll see in the coming months and years. The merger between BPR and KCB, I think, is a new thing in the market, and we'll see how this plays out. But of course, as Bank of Kigali, we intend to maintain our leadership position. Regarding the Russia-Ukraine war, as a country, we are not very exposed to that. But we've seen increased inflation. When you look at last year, inflation averagely was below 1%. And from December, we've seen significant increase in inflation numbers. Last month, February, inflation had reached 5.8%, which is the highest number we've seen in the past years. So this, of course, brings uncertainty in the market. We are yet to see how this will impact the businesses. We believe the government is putting in place measures to stabilize the price of oil products, gas, etc. But I think the uncertainty on the inflation side, on the macro side, remains not much linked to the Russia-Ukraine war, but more to what's happening in the market and the increase of prices. And we'll see how this will play out and how this will affect our industry. Thank you.
Thank you. We'll pause a little bit to wait for more questions if they're there. As there are no more questions coming in, I think we can invite CEO Dr. Diane for her closing remarks. Thank you.
Thank you, everyone, for staying with us early this morning for the presentation of BK Group financial performance. As we've all seen, the group has had a strong performance. And besides the financial performance that we've seen today, I think we've had a very eventful year with the migration to a new core banking system that is fueling our digital transformation and many other projects of big impact that have gone live in the past year. So we are quite confident that 2022 is going to be a good year on the back of the economic performance we've seen last year and the economy reopening in general with all the restrictions being levied, with the many meetings that we are seeing coming to Rwanda. So we are excited that this year is going to be a very good year, despite the uncertainties. But something that we've learned with COVID is resilience. And now our teams are prepared to any headwind that would come our way. And we believe that we'll keep delivering a strong performance to all our stakeholders, our shareholders, but also our clients. Thank you very much.
Thank you, CEO. So we are coming to the end of our event. Just to remind you that the event you can find the recording of the event on Bank of Kigali YouTube channel in case you want to have a look at it. And also we'll share again the press release with the media partners who may not have received it. Thank you and have a good day.